and good afternoon. And on behalf of ASIFMA and SmartStream Technologies, I would like to welcome you all to this webinar. My name is Philippe Dirks, and I'm heading the fixed income division at ASIFMA. We are an independent regional trade organization for the ones who do know us. Who do not know us. We have representing over 150 members, bank brokers, asset managers, law and consulting firms, and technology and market infrastructure service providers. We are the voice of our members, and as we promote and advocate for a liquid, deep, and broad capital market, but also a stable, competitive, and efficient one. So, intraday liquidity. Since the global financial crisis, the regulatory framework has evolved significantly, requiring financial institutions to measure, monitor, report their exposure, both from a credit, market, and liquidity perspective. And this has a significant impact on these financial institutions, could be from a balance sheet and capital point of view. It has led them to review their risk management tools, they're reassessing their operating model, and optimizing their cash management. And the topic is even becoming more relevant today, with interest rates expected to rise over the next year or so, but also in the framework in the context of the pandemic that has brought major challenges and pressure on banks, their clients, but also, as we've seen recently, on the supply chains. Today's webinar, we will explore what we thought are some key aspects of intraday liquidity management. So we're going to start with the regulatory framework and the cost of intraday liquidity. Then we look at the impediment for financial institutions in their day-to-day liquidity management and the required capability for optimizing that intraday liquidity management. We'll also discuss the evolution of payment architectures. Could it be DLT, CBDC, real-time, and what's the impact on that on liquidity management? And finally, we're going to explore how technologies and platform can lead to operational excellence. So to discuss these points, we have a great panel of experts for you today. So we have Keith D'Souza, who's the Executive Director, Liquidity and Funding at DBS. Keith, thank you for being here. We have Simon Gray. Simon is partner at Baringa Partners, and he's based in London. Simon, welcome. And we have Nadim Shamin, who's the Global Head of Cash and Liquidity at SmartStream Technologies, the co-host of this webinar. Nadim, thank you. And you're also in London with the beautiful gherkin in the background.
Yes.
So a little bit of logistic before we start. There's a Q&A function at the bottom of your Zoom screen. So feel free to use that to log in your questions. We will do our best either during the session, because we can monitor the questions, either going through these questions through our discussions, or at the end of the webinar. So we're going to block 10 to around 10 minutes for that. Also, to be clear, the questions that you log into the Q&A box are only visible to the panelists, to myself and the panelists, and not to the other people in the audience. So do not be shy to post your comments and questions. Nobody else than us will see it. Okay, so without further ado, let's now dive into the conversation, and we want this conversation to be dynamic. So each of you, please, gentlemen, to chip in whenever you find it necessary or relevant. But let's start with you, Simon, and let's look at a bit of the backdrop. So what brought us to this point from a regulatory point of view?
Sure. Yes. So I guess back in 2008, there was a financial crisis, obviously, that brought to light some of the challenges around intraday it had been on some of on the agenda of Basel, for example, as part of BCBS 248, and they around that time released a consultation paper regarding intraday liquidity. And really what it was focusing on, as Philip mentioned, it's the monitoring, the management and the reporting elements of intraday liquidity. And that really encompasses quite a lot of different components. So banks are needing to look at their cash management, their kind of big cash and liquidity profiles, but also understand what that means from a risk perspective. So bringing in these elements of understanding their risk framework, as well as their kind of intraday liquidity, cash and security profiles. As that time has evolved from 2008, obviously the regulators have become more aware of the challenges that banks face in meeting their intraday liquidity obligations, and really using this as a lever to put into practice. So we've seen the PRA in the UK, the Fed in the US, HKMA in Asia Pac, really kind of take on the challenge of addressing these with banks. So putting policy in place, reporting requirements that really help banks underpin their capability around their intraday. And really this is focused a lot on the kind of the longer dated liquidity, your LCR, etc., and brought that into kind of more of a real-time intraday, daily, near real-time views. And the reason that challenge is become apparent is that a lot of this happens already within organizations, but the regulators have realized there is somewhat fragmentation to that. So the idea is that they're trying to bring together the kind of treasury components, the operational elements that are settling both cash and securities, and seeing how the risk elements factor into the efficiency components of making sure that the bank is meeting its obligations, which is critical. It's understanding the risk mitigations that it needs to have around availability of liquidity, both where it sits in a bank account, in a nostro, in a custodian, in an ICSD, and how you are able then to make sure that you meet your commitments and obligations that you have. And so there's a few things that really banks are expected to do. Simply, they are expected to understand those obligations, manage them, in terms of the availability of forecasts, ensure that they are able to meet those obligations by monitoring the different bank accounts and resources they have available, and then ensuring that they manage that to both be efficient, but also ensure that they meet the obligations. What was clear from 2008 and as part of the regulatory change that we've seen is that obviously if an organization does find itself in difficulty, what is the ramifications that has across the market and the industry? So ensuring that banks are not only looking at their own capability, they're also looking at what happens further down into their market. And we see things around recovery resolution, which has a real link to intraday liquidity, being able to manage that, and then moving into kind of stressing that and understanding what could happen, and what actions you can take, levers you can pull with your intraday liquidity to ensure that you don't both harm your organization and as well as the market.
Thanks, Simon. There's a few points that you mentioned in terms of fragmentation and certainly be making sure they're pulling all this information together. We're going to be back on that at one point in the discussion. But before we get there, I think that if we talk about intraday liquidity, people talking about about cash and the cost of cash, and we're going to start with busting a myth here, is that even if you don't have to pay for it, cash is not free. And that seems to be counterintuitive. And I'm sure, Keith, that certainly resonate with you, that cash is, contrary to what people think, cash is not free, even from an intraday perspective.
Yes, look, you're absolutely right. And I'd like to pick up where Simon left off. Look, the principles, and some of these principles around liquidity management by Basel and by the BCBS papers go all the way back to 2008. I think even in when they released BCBS 248, the original reference was around the sound principles that was originally drafted in September 2008, though they didn't sort of speak about it in as much depth. But this intraday liquidity thing, I think the regulators have rightly sort of drifted in the right direction. And From then on, left it to the banks to craft their own internal systems around the efficient management. They've laid out the principles very well. I think there were just 6 principles what they listed back in 2008, what they call the sound principles. And to me, those principles are very good. That juxtaposed or read in conjunction with today's rate environment, where everything is as close to zero as is possible, and in some cases below zero for some of those currencies, including euro and yen, would sort of lead to the false impression that the cost of liquidity is zero. If you look at the high level matrix, and my data is maybe a day or two old, we've got excess reserves at the Fed sort of totaling $4.18 trillion, excess reserves at the ECB in excess of 4 trillion euros. Likewise for most of the other countries, including the RBA in Australia, which ran a very nimble balance sheet. Effectively, all the provision of liquidity through different schemes for the better part of 10 to 12 years has ended up on the balance sheet of the central bank. So that's circulation. It's not very effective. It's not very efficient. Banks, for their own part, yes, they're rightly sort of rightly concerned with. Just bear with me for a minute. Rightly concerned with managing their balance sheets a little more effectively, and that's why you see a buildup of surplus liquidity on the central bank balance sheet, not really circulating in the economy. Come 2020, the liquidity situation gets a little bit worse on the back of COVID, with the central banks around the world, maybe not in coordinated action, but pumping in additional liquidity into the system. Just to name a few, you saw the Fed launch 11 additional swap lines. That's over and above the 5 they already had with the BOE, Canada, Japan, Switzerland, and a slew of programs that sort of span both the primary dealers market and even to the extent of providing liquidity to the commercial paper market. But underpinning all of that, yes, this liquidity is not free. This liquidity has a cost attached to it. We often sort of mistakenly look at the front end of the curve and look at zero interest rates and the abundance of liquidity, and don't realize the sort of carrying cost of that liquidity. First things first, that liquidity does have a carrying cost. It's exactly there. The simplest way to look at it is the liquidity reserves that you hold with the central bank. In most jurisdictions, you don't earn much. At the Fed, yes, you don't have a reserve requirement, but the secondary reserves or excess reserves, as they call it today, would give you 15 basis points. That's probably your opportunity cost. But most banks don't have all their currencies banked with the central bank, and even if they do, most of the banks outside of the Fed and BOE and perhaps the RBA in Australia give you zero on your required reserves and give you zero on your excess reserves, and that's equally true for most of the emerging markets. Of course, we'll have to go country by country. So the cost is over there. The second cost is linked there to the greater the amount of liquidity, and that would seem like an easy problem to solve. The best way to solve a liquidity problem is to have excess liquidity, have a pool that is far in excess of what's needed, not only to cater to your end of day needs, but to cater to your intraday needs, and that leads to a balance sheet drag or a cost of carry. I mean, we've done some internal analysis, etc., and realized that for every billion that we hold, this is the additional cost of carry. Look, it's not a very difficult operation. You just have to take your NIM and look and realize, for every 100 million or every additional $1 billion that you hold in cash, that's what you stand to lose. For currencies that you don't directly bank and don't directly clear with the central bank, you're probably holding it through the correspondent banking network. Correspondent banks are now becoming increasingly sensitive to their own cost of carry, not just for the negative yielding currencies, but it's not easy to take huge amounts of cash and hold it with your yen clearer, for example, or a euro clearer, for example, because those banks in turn don't want you to hold these large balances with them. They are subject to regulatory restrictions of their own. The larger they grow, they'd fall into a higher category in terms of their own capital requirements. So they in turn start charging you a charge for balances that you maintain with them. And then the last part I would sort of distill it down to or drill it down to the possible opportunity of deployment. The flip side of that is, if you maintain balances which are terribly small or terribly nimble, you're going to have other costs. You're going to have overdraft fees. You're going to have fees in the form of your standby lines, your contingent lines, etc., that you'd need to call upon or draw upon should your sources of liquidity dwindle. Now, perhaps just an additional angle worth considering is the collateral angle. And yes, today it's becoming increasingly efficient to monetize your collateral, but that also means idling and isolating pools of collateral which could potentially be deployed elsewhere across other sectors of the bank, and maybe in collateral swaps or in other operations. So the combination of 2 and 3, which is your overdraft fees, standby lines, contingent lines, or revolving credit facilities, have a direct cost attached to them upon drawing, and plus the fees attached to it. Or if you have collateral which is isolated, it probably means it's high quality collateral to be able to generate liquidity easily, effectively, and efficiently, which itself means the return on high quality collateral now is at an all-time low. In some cases, if you put in the funding cost, it could even be negative. And that means that high quality collateral, from a collateral optimization point of view, is not effectively monetized. So you've got a whole range of cost across the spectrum, and we sort of don't see that cost up front simply because we're looking at the excess liquidity. And the figures, the numbers are just staggering, right? When we look at what sort of ends up back on the Fed balance sheet, or the ECB balance sheet, or the RBA balance sheet, versus the where the front end, the extreme front end of the rates curve is priced.
Thank you, Keith. And that's interesting, because I mean, if you're hearing on the one hand that from a regulatory point of view, we will have to report, we know that we have to manage efficiently the liquidity. We know that there's a cost for the cash. There's a cost of opportunity if your collateral is not used properly. But nevertheless, just a number of institutions, and the vast majority just can't optimize that. They just can't make it happen properly in terms of management. So Nadim, I'm turning over to you. Why is that? Why can't we just make it happen properly? Why aren't we that efficient, or as efficient as we should be?
Well, I think we can split this in this answer in two forms, if you will. One would be that you've got fragmented regulatory architecture. We talked about Bank of England, HKMA, Monetary Authority of Singapore, and the Fed. They all have, although BCBS is the driver behind it, they all have very different requirements in terms of how they've implemented that. So and a bank needs to be able to provide the regulatory reporting in an efficient and in a timely manner. The other is all around visibility. It seems like that if you look at everything, this goes back to what I used to be selling in years and years ago in banks on liquidity solution. It's all about visibility. To have the visibility about where the pools of liquidity are sitting, where is the collateral, is the information coming on time, are we wasting liquidity, do we have technical solution in place, all of those. What that means is that putting a structure in place has been a challenge. Getting the information has been a challenge. And this has actually turned out to be a little bit more acute in the recent pandemic. We've found that the operational risk has actually increased significantly. And the Operational Exchange has been writing reports on this, and that's increased. So how can, what is causing this lack of visibility and getting the information in a timely manner? Well, you've got multiple internal systems at any organizations, whether that's the core banking system, whether that's trading system, whether it's trade finance system, whether it's your loan book, or even straightforward savings account. Getting that information into a single place in a timely manner is a challenge. In many cases, a lot of that is done on a manual basis. There may be one or two interfaces in place for you to produce your liquidity position, but a lot of them, the information comes on a manual basis. It might even be provided on an Excel sheet, especially if the change in demand on liquidity is not in a system as such. So that creates a delay in getting the information. Then on top of that is that if there is let's say you've managed to create a very nice solution in place where you can get the information on time, what happens if there's a late request of liquidity? Can that information be sent to the likes of Keith in time so that he can actually make the right kind of funding decision and then not necessarily have a late request of providing funding when he's already made the decision? So getting that data and aggregating that data is the key and the challenge around it. Now, on top of that is to be able to start looking at that data, and data is key here. How can you start monetizing that data as well? Now, we'll touch a little bit on that later on to say, we've got a lot of clean data. Can we use this clean data in a different way? Can we work out whether who's the big user of liquidity? Are there some regular abusers of liquidity? Are there internal departments who are mismanaging their use of liquidity because, and here's the key, there isn't a penalty, there is a funds transfer price that is visible to them on this behavior. So we can start looking at behavior as well. Now, I touched upon on the regulatory side of it as well. So most banks, if not all, are able to provide the regulatory reports. Of course, they have to, right? There's no two ways about it. But they've built manual processes around so that they can do their regulatory reporting on a periodic basis. And at the same time, there's also intraday stress testing that is becoming key for many regulators. Again, there are processes in place. They set up their scenarios and run those processes to begin so they can give their periodic stress testing results. Now, what has come to pass, right, in the recent pandemic is that some of those scenarios that have been built in the past are not necessarily relevant. So the banks need to be able to dynamically change those scenarios, get results, and not wait another 5-6 weeks before that scenario result is provided by the teams. By then, that scenario is no longer valid. That's what we've seen in the last couple of years. So I think it's all around getting that data, being able to aggregate that data, getting the data at the right time as well. That's key, and to be able to see with that, how can they look at the liquidity crunch points?
Simon or Keith, anything to?
Yeah, well, there are a couple of brilliant points all through. The couple of points I will pick up is Nadine's first point around bank architecture. Look, bank architecture is constantly changing, constantly evolving, which is excellent. But at the same time, we have a lot of legacy systems that we've inherited because of mergers, because of legacy infrastructure and legacy architecture. A lot of these systems are designed specifically for that vertical. They're designed specifically for that line of business. And despite the fact that they may be very good and very efficient at what they do, feeding that data upstream into a integrated or a comprehensive liquidity management system sometimes isn't as good. Second, you have different parts of the organization, banks and financial institutions at different sort of stages, right? One's implementing a new system today and one's implementing a new system 2 years from today. Again, getting that architecture and getting the seamless sort of flow of information with I wouldn't say real time, but I would say as close to real time as is possible is important. So these are sort of the one or two things I would talk about. The third point I would make is from a regulatory architecture, whether you go back to 2008 or whether you go back to 2013, the initial response was to cater to the needs of the regulatory regime, right? We like we said, we can't skip out, or Nadeem said, you can't skip out of not reporting. If it's a regulatory requirement, you're required to report, whether it's at the end of the day or the end of the month or end of the quarter. You've got to have it, and you've got to have that statement well prepared for the regulators. So to me, a lot of the systems were designed primarily around catering to the requirement of intraday reporting. It took some time, it took some thought, and it took some evolution for banks, including treasury desks, to realize that, well, intraday reporting or intraday liquidity management can go simply beyond just reporting. It's not. It's a little bit beyond, integration of financial architecture, integration of architecture within the banks, and getting the different systems to talk to each other. It's a little beyond reporting to the regulatory authorities in your country or in the countries in which you operate. Suddenly, you began to realize, well, this could be a tool. This could be an environment where you could actually efficiently manage balances, optimize balances. Apart from saving costs, you could actually begin to start making some money off it. You could be a liquidity provider, so on and so forth. So again, to sum it up, I think the initial response was simply catering to the needs of the regulatory authorities, and rightly so. That needed to be done. Then it went into it went into a real liquidity management objective, and from there it has sort of gone into liquidity optimization. And I will say with that the evolution of the outside, the external market, and the evolution of the technologies attached to it has sort of shaped the thinking and helped us gravitate towards really optimizing pools of liquidity, maybe maintaining pools that were not as large. Again, in my opening remarks, I talked about the best way to be liquidity efficient or liquidity solvent was to maintain as large a buffer as you could. That way, you would never fail a payment, you would never fail a settlement, because you had such a large pool of liquidity. But then that in turn leads to the secondary consequences around cost and balance sheet drag.
Simon, I saw that I think you wanted to add.
Yeah, I was going to reiterate a couple of points, but from both Keith and Nadeem. I think I totally agree with the regulatory point. I think that even now we still see organizations set up in silos, right, which is natural evolutions of organizations. But to take the regulatory lens and look at it as a reporting output, as opposed to actually it's a holistic function you're creating, and that's why it's so different, right? The intraday component of your liquidity framework is very different to any other. And actually the reporting element is really demonstrating how well or poorly you've done the managing and monitoring piece. So, organizations, to Keith's point, that are kind of looking at it as an opportunity to look at their systems and processes, look at the data that they have available, is really important. I think, that then we're seeing organizations, to Nadeem's point around stress testing, really start changing that dynamic nature of it to understand what could happen, what would that mean for them, and then both optimally, what levers can they pull, but also to manage risk, right? How can they ensure that they can continue to perform the activities they need to, but know what levers they have available. And I think that's why it's so key. I totally agree on the efficiency part as well. Just that actually by making it transparent to the business, there can be obviously a cost allocation via an FTP process. But actually, if you think about the commercial minded nature of the business, they are there to kind of drive some efficiency naturally. By bringing them into the forums and to let them understand the costs and where that cost is driven from, and then you start seeing actually the true cost overall of trading of a business, can really kind of start changing the dynamic a little bit, and you can guarantee they'll be straight at the table to support that, right? A lot of activity that impacts intraday happens there all the time, but we're just seeing it done in silo. And what intraday is trying to do is bring it into a cohesive view, which is where Nadeem's point around data and technology comes in. You really need that capability so that you have that, you can then influence the business to either through FTP or through, the more flexibility of your overall inventory to make sure that you're not leaving excess and you're able to use the liquidity more effectively, but also that you then know how to start controlling it should you see an idiosyncratic or a market stress that you need to navigate through. and the data availability, I agree with Keith, right? Near real time will spot elements that you see and potential pitfalls, and then allow you to know what action or management actions or levers you can pull to try and mitigate some of that.
We have an interesting. Yeah, go ahead.
No, just one point to supplement what Simon just said. That the FTP, I still think is a brilliant mechanism, but along with the evolution of the market, I think internal systems and internal policies would have to sort of march in stride or lockstep, because FTP generally tends to work on an overnight and on a term structure basis very well. We're still struggling with FTP applicability on an intraday basis. You do see a lot of banks charge you on an intraday. The Fed does it, whether it's collateralized or uncollateralized, and I think banks are going to have to step up, particularly to Nadim's earlier point and Simon's point around sort of fragmented internal financial architecture, and what's the real cost and true cost of liquidity. So I'll just sort of hold my thoughts over there around FTP. It is a brilliant mechanism, but it's got a little way more to go.
Yeah, we have a question here. I'm not sure if we're going to tackle if we answer this question now or later on. It's regarding the various pool of liquidity and the multiple settlement center. Is it better to centralize all liquidity in the US or to have local pools in different time zones? I'm not sure if we want to start discussing that now, or maybe later once we're talking about solution and platforms.
I think we can accumulate this question to the end, and then because there's merit in both. There's merit in a geographically fragmented pool, but let's pick that up.
Let's pick up that later. So, person who asks that question, make sure that please rest assured we'll come back to you on that. But this, if we're looking at this, also one significant element that really also changing the way people are looking at liquidity cash is really the way the overall architecture, payment architecture is transformed. So we're talking about DLT, we're talking about CBDCs, we're talking about also about shortening overall of the settlement cycle. We're moving now to virtually real time. I mean, it's even if the correspondent banking now is virtually real time. I used to have been kind of worked for Swift before, and now with GPI, clearly, and I don't want to make marketing for them, but clearly, you sending money across the globe almost in half an hour, it's finished for having these 2 or 3 days. So clearly there's a new dynamic, there's the new architecture environment in which banks have to evolve with real time, with blockchain, DLT, Bitcoin, and all the digital currencies, and the shortening of the settlement cycle is really also transforming the way we're looking at that. So maybe either Simon or Keith, one of the two, maybe you want to elaborate on that.
I definitely think you're right. It's not a kind of shall we do anything. It's we need to do something, right? It's not if but when. I think your point around the fact we're moving to a more 24/7 kind of infrastructure in the industry is just meaning that banks will need to manage this. We've talked about the fact that organizations already and certainly on the agenda of a lot to charge for intraday because they know they need that more dynamic nature as things become more apparent. So the ability to manage these as new efficiencies, as new products, as new initiatives and innovation takes hold within the industry, we need to make sure as organizations that we're able to address those and support them within our infrastructure, because the alternative is you end up with bolt-ons at the end of and at each end of your kind of silo systems and processes that you're not able to marry up, right? I think your point around Swift GPI and things like CLS now is creating great opportunity, but if you're not able to integrate it well into your organization, then we're seeing already people are having to manually manage some of those components, hold actually more liquidity to support payment infrastructure or schemes faster payments is a great example. People hold excess liquidity to support that because they're not able to monitor and manage on a real-time basis. So, I think organizations that are, sat back thinking we're actually okay, we're holding huge amounts of liquidity, there is that then efficiency point around, no organization that I've seen is the same. Every organization is somewhat different because of its geographical footprint, because of its product sets and alignments. So it really needs to be understood at an organizational level how you're going to interact with the market. What is your entry point? How do you then manage that, and how do you ensure that you're future-proofing that from a technology and data perspective? Because entering into 24/7 markets is challenging, and what you don't want to do is see inefficiency, hold huge liquidity, and then expose yourself to more greater risk in those markets that are potentially unforeseen.
Yeah, and it's not because you're 24/7 that the liquidity is available 24/7. I mean, your systems are open 24/7, but the access to liquidity might not always be 24/7. And I think that's probably a challenge that a lot of real-time market and 24/7 markets are facing. You might have the windows open 23 hours or 23 hours a day. The liquidity will definitely always be locked in a few pockets during and windows during the day. Maybe Keith, you wanted to add something.
Yeah, look, at this point, we are no longer talking about to me, we're no longer talking about the future. We're talking about now. You've already, and Simon's already referenced CLS now. We've talked about Swift GPI. APIs is maybe 5 years ago people wouldn't know it, but today commercial bankers know what's an API. And it's sort of difficult to say whether the private sector is taking a leaf out of the central bank book, or whether central bankers are taking a leaf out of the private sector. But each one's racing ahead with 24/7. Nobody's ever talking about 21/5 or 22/6. Everybody's talking about 24/7. You have the RBI in India, who over a period of 2 years took both NEFT, which is I think the National Electronic Funds Transfer, and last year RTGS live 24/7. The BI, the Bank Indonesia, is on the brink of doing it next month, 24/7. The Fed intends doing it. They've sort of launched Fed now. I think they've sort of curbed or limited the amounts, but whether it's 2024 or 2025, that's inevitable, and that's only the central banks. On the private sector side, the banks are talking about DLT. DBS itself has launched a DLT-based payments company with 2 other partners, and these payments can potentially take place 24/7 on DLT. So if I use DLT and blockchain interchangeably, then you have the retail sector, which from studies will show you sort of like to make their overseas payments, whether to their families overseas, particularly over the weekend. So you got to sort of cater to those requirements. Again, it means idling pools of liquidity to cater to not only cross-border but cross-currency payments, because you could have them working in one country and sending their remittances back. And remittances today is a huge business, particularly for Asia, Latin, and the North America as well. Walking in step with them is the central banks are launching CBDCs, and CBDCs have no intention of being operating according to RTGS. They're going to operate online and real time. The technology will probably be DLT or probably blockchain, but CBDCs for instant settlements is going to be not a thing of the distant future, I'd say. There are several pilots underway. Singapore's got one pilot going with 4 countries. Hong Kong's got the MCBDC bridge going with 4 countries. Yes, at this stage there are trials, but trials inevitably lead to an interconnected world. These initiatives, CBDCs, DLT-based payments, Swift GPI, instant payments, fast in Singapore, faster in Hong Kong, is inevitably going to lead to a 24-hour management particularly for the Treasury desk. It's going to lead to sort of greater fragmentation of pools of liquidity, but there will also be the need for greater optimization of those pools to be able to transact not only faster, which is what the consumer expects today, but also a little more effectively. On that point, anybody who makes a payment, if you do ask them how soon or how fast do you expect the beneficiary to see it today, the automatic answer would be a few seconds. So gone are the days when you would sort of make a payment and it would go through the different hops through the correspondent banking network and reach the eventual beneficiary sometimes up to a week later. So I think a combination of technologies and then initiatives both by the private sector as well as the central banks, whether you like it or not, is going to drive intraday liquidity management to the forefront.
So,
I think just to
go ahead, Simon.
Just really quick to add to the costing element to that. So the fact that there's going to be a cost associated with that, we're going to see that. I think you make a really good point. We see a lot of individuals or organizations that have kind of monthly pay cycles. So they'll have an invoice come in and you've got 30 days to pay it. On day 30, they want to press a button and within milliseconds that payment to have been received by their beneficiary. I think we're going to see an evolution of that actually within that 30-day period, when is the most efficient point to make that payment, both on the kind of customer or client's level, as well as the kind of institution from a liquidity perspective. And we'll see a way of optimizing that cost to ensure that that's the best way, as opposed to pressing a button and a millisecond later it was being received by the beneficiary, even though you've had 30 days to pay it. That's the kind of mindset change we're going to see. And I think, without answering the full question, but going back to that pause with liquidity, you need to understand what are your levers that you have available, where are you sourcing your liquidity from, what are your obligations, and what is the most efficient way to run that. Because to follow the sun model, if we're suddenly in 24/7 markets, will not be that you can pass your liquidity over from Asia Pac to Europe, then to North America. We'll have to see a difference in how you manage your global liquidity. I think that's what's clear.
And to your point, I think that it's not only limited to what we call in cash, because it's also anything of pure cash trade and the like. It's also securities related. If you're talking about corporate actions, I mean, there's also a need now to have instant payment of that the corporate action proceeds will flow directly to the holder of the security and not being held for a few days or a few weeks with the paying agent. And I think that and you're absolutely right. I think that on many aspects, the expectations from both the corporates, the financial institutions, and the retail are really changing the way the money is going to flow. And that money, could it be linked to trade, linked to securities transactions, or anything else? Remittance, to your point, Keith, is also something extremely important. Or just supporting your family across the globe. When I'm sending money to my daughter, she's in the UK right now for studying, well, you want to make sure the money arrives on time. But all of that puts, of course, pressure on the liquidity and on the banking system. Not me on my own. I would love to, but that doesn't happen. But clearly, as a whole, it does. So that means if we are all hearing that the difficulties of the cost of cash, that the new architecture, the reporting requirement, the fragmentation of the internal fragmentation and the regulatory fragmentation really requires institutions to have a robust technology infrastructure, robust systems, and tools to address that. So, I mean, turning over to you, Nadim, and Celine, that's really your area. What is required now for institutions to really being able to manage that efficiently and really to get to the state of the art of intraday liquidity management? And you're on mute.
Sorry about that. So, listening to the comments that both Keith and Simon have made, it's evident that in order for especially with 24/7 demand on liquidity coming through, it's evident to be able to look at the existing data and and predict the need on liquidity. I don't expect Keith to be sitting 24/7 in front of his laptop or his smartphone looking at his position saying, do I need to optimize this liquidity now? So you need to start looking at the data. How can that data be used to predict the demand on liquidity? Can we start using machine learning tools or artificial intelligence to start predicting, forecasting and create those models on the liquidity itself? Now, and the next step on that would be, okay, what are the new technologies in terms of financial technologies coming as well? There's a discussion around intraday repos that are coming in the market. It's very much in its infancy, but that's something that would help manage that liquidity. First thing is to know what it is. Then obviously, Keith, you mentioned you need to be able to optimize it. So there's another element coming through. Now, if I look at the first point on the machine learning side of it, if we at any given point in time, when you look at your intraday liquidity position, you have certain number of predicted cash flows that have been settled, but you still have quite a few commitments left. Let's say at 11 a.m., you've got quite a lot of commitments still left. Then you need to know when would those unsettled cash flows will occur. So is that settlement time likely to create a crunch point during the rest of that day based on the potential delayed receipts, the available liquidity on lines, etc. So if you have that predicted settlement time of receipts, you can also predict the settlement time of the payments. So potential missed payments, delayed payments, if it gives you an early warning indication to say, I need to call XYZ bank or counterpart to say, there's a large payment coming through. Are you going to make it? What time are you making it? Or if there's a likelihood of that payment to be missed, can Keith go ahead and allow for additional liquidity for that purpose? Now, on top of that, again, looking at data as well, there is a market trend to look at, again, stress testing in a more BAU process as well. So to create those stress tests to understand where, again, I keep using the expression liquidity crunch points, it's quite critical in finding that out, to understand where are the vulnerabilities in the system itself and create those remedial management actions. It can also help you predict, again, what would be the delayed payments. And if there are time critical payments, that's a key issue for you as well as a bank. And as part of the stress testing capabilities, you need to be able to say, what happens to my liquidity if one of my counterparts is under stress, or if a bank delays payments or fails to settle? Do I know whether any of my Nostro agents is likely to fail, or is there too much concentration on one or two agents? Again, if you have tools available, this is where the analytics tools come into it. So again, looking at data, looking at the what analysis you can gain from that particular data to make it a more of a BAU process. An earlier point was made that, in faster payments, whether there is how do you manage your liquidity? Just leaving large chunk of cash is just no longer acceptable. That's passive management. Yes, it may keep you safe and meet your payment obligation, but it's not the best treasury management process.
You might end up even be charged for that. I mean, some institution might actually be charging you for leaving long balances. In the past, people were very happy to have long balances of their clients on their account because they could make money out of it. Now that's no longer the case. So, I mean, conscious of time here. Exactly.
You're absolutely right. While I was working for another organization, that was part of my role to say, look at where the large corporate and banks left their cash sitting around, and there was a massive conversation at that time. This is going back a few years. Do we start charging them? Of course, everybody's doing that now.
No, it's very true. I mean, conscious of time here. I mean, we are 8 minutes to the end of our conversation. I think that we could go on for probably another hour. We probably need to take a follow-up session in a few weeks so that we can continue that great conversation. But I would like just maybe to address the two questions that we have received on the chat here. So back to the pools, it's better to centralize all liquidity in one location or to have local pools in different time zones. That's the first question. And the other one is there an informal or formal group initiative among major financial institutions to have a gold standard of intraday liquidity pools? So that is an interesting one, and I think that probably steps on the toes of some of institutions who providing these liquidity management solutions across for their clients across multiple jurisdictions. But if we can maybe start, and maybe Keith, I think that you were keen to answer that question in terms of the single or multiple liquidity pools.
Yeah, I'll take a shot at the first one, and let me start off by saying in an ideal world, it would be ideal to have a single pool of liquidity at a single bank. That's ideal. If I draw a slight parallel to what Nadim talked about earlier, even from a correspondent banking point of view, there's a preference to have a single currency at a single bank. Now, of course, there's the flip side to that coin, where from a resolution planning point of view, from a contingency planning point of view, you'd probably need 2 or 3 banks. But when you start to spread it out, for whatever reason, your pools of liquidity start to get fragmented. So what would tend to happen is you'd invariably see balances during the day accumulating in one account for whatever reason, because there's a certain pool of customers that remits its balances into account A, well, as you tend to make payments from account B, and so therein begins then optimization. Let me sort of transpond that example back into the original question. The preference is always to have a single pool of liquidity with a single clearing. Now, very few banks in the world can actually do that. The Fed is probably a prime example, and the ECB comes in a close second, because the Fed operates 21.5 hours a day. So from the time you open in Singapore at 9 a.m. on a Monday morning, you can effectively do Fed clearing, and that's fine. It starts to get a little more complex, where maybe a bank in Southeast Asia doesn't have direct access to the Fed and has got to go to maybe one, in some cases 2 correspondent banks. Second point is the fungibility of the currency. Now, dollars by and large is fungible, but a dollar, let's say in Indonesia or in Vietnam, may not have the same fungibility of a dollar in Singapore, Hong Kong, London, or the United States itself. So the currency is fungible, but local regulations around capital control and two-way both convertibility and fungibility kick into play, which means it might sometimes be a little more efficient, again, depending on the currency, depending on the pool of liquidity, to have clearing in a central block. The HK Chats is a prime example, and some of the overseas countries, I believe, can link in through correspondent banks, and that helps with a pool of liquidity. But if you ask me for a purist answer, the purist answer would be to have one central bank, one universal time zone, and a centralized pool of liquidity. But therein, after that, the complexities kick in around convertibility, the complexities kick in around direct access to the Fed. And in the case of some other central banks, whether they operate for a period in excess of 18 to 21 hours, covering Sydney, or even Auckland in New Zealand, all the way to Los Angeles in the US West Coast.
Yeah, I just quickly agree with that. I think Keith's right. I think that we're seeing an evolution, right, in organizations use their liquidity more efficiently. I think they've been pushed to do that. I think things like IHCs and recovery resolution has meant that organizations have had to address that in terms of how they operate their kind of more global versus regional components. So I think, you need to understand the nuances, as we said. So there are going to be challenges. I think it's really important that you understand the markets that you're in, and especially for the attendees on this call, is to understand, how from a overall liquidity, not just cash and payments, how do you ensure that inventory is managed well? What are the nuances from a regulatory perspective, markets perspective, infrastructure, right? The settlement kind of components and trading elements that you have, to ensure that the levers are there. And I think that's really important, that the levers you have are so critical. And I think Nadeem made the point that there aren't many, right? At the moment, we're seeing efficiencies and opportunities around intraday liquidity markets, repo, FX. They're not really there yet. So there are limitations to what levers you can pull. One is really working with the business and the inventory management you have.
Thanks, Simon. Now, I mean, before I hand over to you, Nadeem, for closing remarks, I'm not sure if there's an informal or formal group initiative among financial institutions to have a gold standard of liquidity pool. I think there's probably, my understanding is that there are definitely initiatives on the standardizing the data and the way these data are exchanged among institutions, therefore streamlining the way these data can be processed within organization. But I'm not sure there's a formal initiative to standardize the way liquidity pool are managed. I mean, anybody here can have a view on that?
There's certainly nothing formal. I'd say there's conversations that happen, and even way back in 2008, I know that there was kind of certainly the broker-dealer community were talking around how, because they were already seeing the pinch from the liquidity generally they were receiving from clearing banks, but it wasn't anything formal. And I think there is a big difference in maturity that we see with organizations from, the low end of just meeting the regulatory requirements to almost what Nadeem was talking around, some of the AI and machine learning components. So because of that vast difference of maturity, it's very hard to get organizations really to aligned on, how do we make this more efficient at a market level as well as an institutional level.
Good. Well, gentlemen, thank you very much. It was a pleasure. Maybe Nadeem, over to you for the final comments and closing remarks.
Thank you, Philippe. So what we've heard is that there are challenges in getting the right data at the right time to make the right decision. To be able to operate with confidence within the set guidelines and have tools in place to generate the alerts where needed. It's not just about having a liquidity position at various points in the day, but have it as near real time as possible. Having a periodic stress testing capability can help meet regulatory requirements. Yes, we've addressed that. We agree with that. I think everybody would resonate with that. But it's becoming evident that the ability to carry out dynamic stress testing on demand better provides a position to make a decision and through changing scenarios and metrics. Finally, and I won't take very long, finally, new technologies such as cloud-based solutions have become the norm. 2 years ago, people were just thinking twice about that. Similarly, now, use of AI and machine learning is no longer restricted in the innovation labs. It's being discussed at commercial bank meeting rooms as well. So it's the point with that is that it's going to be more and more important to be able to predict the behavior of liquidity usage. With that, I close my remarks.
Thank you very much, Nadeem. And it was indeed a pleasure, ladies and gentlemen, to have a conversation with you today. For the attendees, thank you very much for your time. I hope you enjoyed that as much as I did. And again, if you believe that some of these topics that we've talked about today are of interest to you, please do not hesitate to reach out to either of us or to my colleagues or myself at ASIFMA if you believe it is something that we as an organization and a trade organization, we could help the community with. On that, I wish you all a very good evening or rest of the day for the London-based ones. Thank you very much.